Hi Dreamers, quite a few of you have asked me to update a video that I did almost a year ago. And it was this one where I said, hey, what would I do with $10,000, $50,000, or $100,000 right now? What stocks would I pick? How would I construct the portfolio for passive income? And it seems like quite a few of you want me to do this again, given current market conditions and stock prices. So let's do it. Now, one of the things I've done right before this video is go into Seeking Alpha and create a few different comparison charts, which is fast becoming one of my favorite tools. Basically, you can just click this Add Comparison and then just easily add ticker symbols like this, and there you go. One of the other things I like about it is that you can also easily move positions and then compare. Now, the other thing I wanted to add is just the general stats that I'm looking for. Essentially, I want yields that are above 2% minimum, hopefully closer to the 5% range. I typically like stocks that have a low beta, and I'm looking for betas under 1. I like to see at least 10 years of dividend increases and a pretty long history of consecutive dividend payouts, at least 10 years, and hopefully more like 25 to 50. I also like to see payout ratios in the 40 to 60% range. And those payout ratios go much higher for certain types of stocks, like typically the tobacco stock companies that are paying out very high ratios, and also telecoms and utility companies. And lastly, I want a 5-year CAGR that is minimum 5% plus. So those are some of the key stats that I'm looking for. So I've gone ahead and pre-selected some of the stocks that I feel like are a little undervalued right now. And I've put them in this chart where we can see the last 10 years. So here we have SLF, which is Sun Life Financial. And you can see the total return. Sun Life Financial has done the best over the past 10 years, followed by BMO, which is a bank, Bank of Montreal, Mo, which is Altria, EBF, which is a small cap stock, which I typically steer pretty clear of. But what's interesting right now is if I look at my total portfolio and actually sort by Wall Street, you can see EBF is rising to the top as a top pick. When I also go to top rated dividend stocks, of all Seeking Alpha, you can see EBF makes the top 20. So this is one at a 4.67 yield that might be kind of interesting for folks right now. And you'll also see some of the other ones we'll talk about soon. A lot of the REITs, in fact. You see Cube right here and Getty. So going back to our comparison chart, we've got, after EBF, one of my absolute favorites, BCE, returning 76%. Now, the reason why you'd include BCE in your stock portfolio is because it is so incredibly stable. So you get more of a guaranteed bond-like return. And BCE is essentially like the AT&T of Canada. And then we've got BTI, which total return is actually pretty low over the past 10 years. But I'm pretty bullish on BTI for the next 5 to 10 years. So that's why it's in my picks. All right, so those are some of the stocks I would be picking right now. So let's take a look at SLF. And I actually started loading up on SLF just in the beginning of this year. And you can see that it's actually continued to rise just over the past couple of months. So not getting it at the very bottom, but you can see this bottoming out right here for SLF. Let me show you BMO. You see kind of a similar thing happening here with BMO. So I've been adding to BMO lately as the price is a good value relative to where it's been. I'll show you one more, BTI. And I know that tobacco stocks are polarizing. So if you feel comfortable with owning them, I really think BTI is going to be a pretty nice winner. And so you can see we were up around $47 about a year ago, and it's dropped about $10 since then. And I think it's getting closer to the buy range for BTI. All right. So let's say you pick from this group of stocks. What I would do next is actually add some ETFs to that. And again, I've pre-selected some of the ones that I'm most interested in right now. And so here we've got everybody's favorite, the big winner in ETFs, SCHD, which has actually outperformed the S&P 500 in the long term. Next one that's performed pretty well historically is BST, followed by Devo, and here I have JEPQ. Now this one obviously hasn't been around as long, so let's say we change it to a year. And you can see the relative performance over the last year, which has been pretty horrible for everybody. But BST and JEPQ are very much based on the NASDAQ and science and technology. So I'm looking at BST and JEPQ to start to rebound and benefit a little bit, given that I think tech stocks have started to bottom out. And I talked a lot more about these in a recent high yield video. So that's about all I'll talk about here now. The next thing I would do when constructing a portfolio is add in some REITs so that you have some exposure to the real estate. And here I've got some of my favorites and some that I think are of value right now. It includes Getty, Stag, WPC, and APLE, which is a hospitality REIT that got pretty creamed during the pandemic, but I think is ripe for growth over the next 5 to 10 years. And Cube is kind of interesting. It's actually one I don't own that I've been looking at lately. And you can see the nice returns that have come in over the past 10 years for Cube. I like the storage space industry, so it's one that I'm considering owning, but I don't like to double up. But look at that total return. Pretty nice. And finally, of course, I'd be remiss if I didn't talk about some key growth stocks. Because if all you're focused on is immediate yield and cash, you're going to be missing out on the big growth that can happen across a 10-year period with some of these guys. So take a look at this stock. It's actually one of my favorites. It's Avgo, with over 2,000% total return over the past 10 years, which has blown Microsoft and Apple out of the water. Think about how shocking that is. It's also got one of the best yields at around 3%. And so we'll take a look at that as we build this out in the estimator tool. Then we have UNH and Google, which has been pretty hit hard lately. And finally, ADP, which is another stock I covered in a recent video. All right, so with all of this said, let's go to the income estimator tool and start building this out. All right, so now we're going to the TD Ameritrade Income Estimator tool, which I've confirmed with TD that they are getting rid of when everyone switches over to Schwab. That really stinks. And actually, it's a reason why I started moving a lot of my investments back over to Fidelity. Let me tell you, this really sucks because this tool is one of the best tools out here for what-if scenarios like this. All right, well, let's use it while we can. So let's say I had $10,000 and I was starting from scratch. What would I do? Let's start building this out. Well, definitely I'd put BCE in there as a starter. So you can see here, you've got BCE when the next payout date is, the current dividend yield of 6.3. And it pays out quarterly, and you can see exactly when it pays out: April, July, October, and January. So let's add in our positions and then kind of move things around. If I only had $10,000, I probably would keep it to 10 positions or less. So let's try that and see what it looks like. The next thing I'd add is one of the tobacco stocks. And gosh, it's really hard to pick between BTI and Mo. But for now, I'm just going to go with BTI. And I would definitely add in one of those Canadian banks that are rock solid with very low payout ratios. So I'm going to add BMO in here because it's at a low price. And to that, I'd add another Canadian stock, SLF. Now to this, I'd add some core ETFs like SCHD and probably Devo, because in my mind, Devo's kind of like SCHD with a little bit more income. As you can see, SCHD pays out 3.3 and Devo pays out almost 4.8. And it's monthly, which is fantastic. To this, I'd add maybe a couple of REIT stocks. So I'd go with Getty and probably WPC next. And so what are we up to? 1, 2, 3, 4, 5, 6, 7, 8 stocks? I'd probably add Avgo because it's one of my favorite growth stocks with a really good dividend yield of almost 3%. And finally, probably Microsoft, because in my mind, this is one of the strongest companies out there with some really interesting growth opportunities with Activision Blizzard. All right, so let's say this is your set of 10, and we gotta get this down to about $10,000. What's a good mix to both generate cash and have some growth in there? Here's where we start changing the quantities to do what-if scenarios. Let's take all these down to 10, and you hit calculate income. All right, we're getting close with $13,000 generating 414. If you sort by dividend yield, you can start to see what your highest payers are. BTI, BCE, etc. So I'd probably shift some away from Microsoft and Avgo in order to keep the income high. And these are pretty expensive per share. So if we hit calculate income, and maybe add a little bit more to BTI and BCE, and there you have it, right around $10,000, generating $389.89. It's got an average yield of 3.87 across this portfolio, and the payouts are pretty well distributed throughout the year, which is nice. Now, the only issue with this portfolio is just how many international stocks there are, because BCE, BMO, and SLF are all Canadian stocks, and of course, BTI is British. So that, I would say, might be one downside of this particular portfolio, because the exchange rate will actually affect how much you get paid out as the exchange rate fluctuates up and down. But overall, value-wise, these are great picks right now. Plus, I like the spread of diversity. You've got tech stocks, financial, some diversified ETFs in Devo and SCHD. You've got your REITs, telecom, and tobacco. So that's what I might do with $10,000 if I were to start from scratch right now and just start forming a base. Okay, what would I do if I had $50,000? Well, definitely I'm going to add in Mo. That's the first thing I would do. And I'd probably add in another REIT too, like Stag. And at this point, I might add in that small cap stock, like EBF. And although we didn't cover it, we're missing healthcare. So I'd probably add in either Pfizer or AbbVie. Let's go ahead and add in Pfizer. And I do like the look of that cube. So maybe, since this is what if, let's go ahead and add it in. Okay, so now we have a chance to kind of equalize the shares inside of this. Let's change Mo to 50, EF to 50, and then start to bump up BTI, BCE, SCHD, MO, SLF, and our growth stocks. Calculate. Okay, now we're getting closer, about 42,000. A few more changes to round out the REITs and up Devo. Maybe add a little bit more to our tech stocks. All right, so this is close enough, guys. 51,500 gives you $2,000 a year. So in this scenario, you've got a couple of tobacco stocks. You've got your telecom, real estate, a little bit of an income play with Devo, a small cap stock that's growing with EBF. You've got your Canadian financial rock solid companies, another couple of REITs, a healthcare play, which I think is important. And I should have included from the beginning. You've got your old standard SCHD, and then really nice growth plays here. So that's what I might do with $50,000. But you asked me what I would do right this minute. And if I had another 50K, I would probably do a couple of things. For one, I would add in the cash layer of JEPQ. I'm attracted to JEPQ because it's tied to the NASDAQ, which has been absolutely pummeled. So I think it's got a little bit of upside, even though it's capped because it's based on equity-linked notes and derivatives. But it's going to significantly juice this income play. So I'd add it to the mix. I also think it's important to add more growth stocks. So I'd go ahead and add back in ADP, UNH, and what the heck? Let's add back in Apple. I would probably add in AbbVie at this point as well, just to have another healthcare stock. And I do like that APLE, Hospitality REIT. I think this one has a nice runway over the next 5 to 10 years. So that brings you to a nice 20 stocks. And from here, I'd start moving things around. Alright, so I've played around with this, and I've ended up with 150 shares of JEPQ, 100 shares of MO, 100 of BTI, 125 of BCE, 100 of APLE, which is still less than 2,000, 50 of WPC, 75 of Getty, 100 of Devo, 100 of EPF, which is again only $2,000, 50 of BMO, 100 of SLF, 100 of Stag, 50 shares of AbbVie, 100 of Cube, 100 of Pfizer, 50 of SCHD, 20 of ABCO, 20 of ADP, 20 of UNH, and finally 20 of Microsoft. And so in here you have a blend of a cash layer, some cash producing bond-like dividend kings. You've got some nice REITs in here, ETFs, healthcare, etc. And some nice growth down here at the bottom. And so in total, this portfolio of about $100,000 would kick off $4,467, have a yield of 4.42, and it kind of plays nicely as well across the year. Now, like I said before, I'm building this portfolio for the long term, something that has stability and a nice growth path, not focused just on a high yield to generate as much cash as possible. This has really nice balance across geographies, industries, and kind of has the best of both worlds in terms of cash production and growth. So you asked me what I would do right now, and this is what it looks like. Alright guys, if you're interested in Seeking Alpha, where I do a lot of my stock research, please feel free to check out the subscription link below. Well, that's it for today. As always, I encourage you to do your own research, then implement and learn by putting it into practice. As a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.